Good morning to you both. Yurian, I'll start with you. The moves we have been seeing in the bond market, as well as the currency market, and now subsequently in the equity market. Your take on where we are here and how much further we potentially have to fall in something like the S&P?
Well, so it's nothing but moving targets right now, right? So the Fed's surprised by being even more hawkish than they have been. That raises the 2-year yield. That raises the real 10-year yield. And to me, that 2-year and that real 10-year are the primary drivers for this particular cycle. They're not always the drivers for other cycles, but in this case they are. And if you do a simple regression of the forward PE against those two variables, you find that it has been a moving target, right? In June, the fair value for the S&P was 15 times forward earnings. We got there, then we rallied 17%, completely unjustified by the fundamentals. Now we're back down there, but now that forward PE, that's fair value, is down to 14 or even 13 times, and that brings you down to 3,300 or so on the S&P. So we're probably not out of the woods. It'll be interesting to see, technically speaking, if we do undercut that old low, whether we start seeing some juicy bullish divergences in some of the breadth and momentum indicators. But we're not there yet. So that's a moving target, and that's assuming that the forward earnings estimate, which is $235 for the next 12 months, ends up holding, right? So if we end up getting flat earnings instead of plus 10% earnings, then you apply that 14 times or 15 times 219, and that gets you down towards the 3,100-ish. So my sense is that this decline is not over, and it won't be over until the Fed cycle finishes. And at that point, we'll see whether there's a soft landing or a hard landing.
I appreciate that off-the-cuff math right there, and certainly it's very sobering, this conversation we're having. Omar, do you agree with those comments from Yurian? Do you think there's more pain to be had here?
Well, it's kind of an interesting question, because when you look at the observations, we're back to June. If you think about where we are in terms of technicals, in terms of forward earnings, multiples, and you think about the structure of the equity market, we feel like we just basically went back to where those numbers. The biggest difference is that we have over 17 global central banks that have actually raised rates just over the last week. And what that means, including the Fed, is that everybody's just rushing to try to get these monetary policies so tight that it's actually making the outcomes to just be much, much uncertain. On the one hand, we all know that monetary policy takes a while to get into the real economy. So every single thing and every single move that the Fed has done and will continue to do will take a while to just see what the effect is in the economy. And I think the biggest challenge today is for investors to try to understand, how much of this lagging component will be reflected into earnings going forward. Everybody knows that it has to come down. Everybody knows that these earnings estimates need to be, adjusted. But at the same time, they're trying to realize that whether or not the economy is strong enough to actually provide that support. So the range of outcomes that we can have from here on is as uncertain as it was back in June. We can actually have a very clear support with the labor market, the housing market staying, not too bad. On the other hand, we can actually see those effects of the economy to just take us to a lower level.